Good morning from our global headquarters in New York. I'm Menace Cranny alongside Danny Berger. You're welcome to Bloomberg Brief. Let's set that agenda.
Stocks turn lower, bonds rally. Local reports state that Ukraine has carried out its first strike in Russia using American-made missiles. President Putin approves expanded use of nuclear weapons. Narrowing the search, President-elect Donald Trump is said to be considering Kevin Warsh for Treasury Secretary and Scott Bessent for the NEC. And the last push from Biden's DOJ, the plan split Google and its Chrome browser. We're going to have more on that Bloomberg scoop coming up. Good morning, Manus.
Danny, good morning. I think we've just had a refresher course in the past 45 minutes of what it is to be pushed around by geopolitical headlines, this approval of an updated nuclear doctrine. There's nothing particularly new in that. We know that this was coming. We'll talk to Mark Champion in a moment. Stocks are lower. So much for Goldman Sachs. I mean, they've got a new target at 6,500, up from 6,300. Maybe this is an opportunity you buy the dip on any of these geopolitical drawdowns because the market will remain fiscal friendly. Roll it over. Have a look at the bond market. We both looked at these markets. The first jolt came with the strike from the Ukrainians into Russian territory. And then, Danny, we saw a second wave on this updated doctrine from Putin.
Yeah, it really just shows you how sensitive these markets are, Manus, especially at a moment where oil has not reacted to this. It's the equity market and the bond market. And maybe that shows you just how much we've moved and how sort of nervy we are at this moment.
Yeah, I mean, and you and I looked at this. If you look at the reaction function, it's much more aggressive in Europe, less so in oil. You looked at the bond market. They were down 10 basis points. They recovered. Yen, money is flowing into yen. It's the very immediate knee-jerk headline. Risk off, restraint. Yeah,
we'll see what sticks. And if anything, to your point, Manus, it just underscores the volatility that we might be dealing with in 2025. The year is coming to a close. Already, strategists have begun to release their year-end targets for the S&P. Over the weekend, the usually bearish Mike Wilson of Morgan Stanley set a more bullish price target of 6,500 by year-end. Goldman Sachs' David Kostin matched his call, writing, in our baseline macro outlook, the economy and earnings continue to grow and bond yields remain around current levels. Joining us now is Emma Wall, head of investment analysis and research at Hargreaves Lansdown. Emma, how do you even think about next year when you're going to have a new president in the United States, different policy, and yet again this morning we're reminded of the geopolitical risk happening around the world?
Yeah, so we think the two big words for 2025 are going to be volatility and value. So volatility, we've already started to see it this year, with macroeconomic outlooks changing all the time, bond yields jumping all over the place. I mean, it's been quite an extraordinary time for bond yields that you've had two cuts from the Federal Reserve, and yet, your 2, your 5, and your 10 are above 4% yields, higher in some cases than they were July before the two cuts. And that just really is showing actually how much uncertainty there is going into 2025. What the market thinks President Trump will be like in terms of expenditure. We think there's going to be spend in terms of growth. We are bullish, actually, on US equities, although we actually think the value is in the smaller companies, or US smaller companies, which in the UK would be multi-mega caps. But US smallers, more domestically focused, those that aren't going to be so hit by tariffs. But yeah, certainly volatility across asset classes and value, as in take it where you can. It's going to be bumpy. Like today, an opportunity perhaps to buy in while valuations are slightly depressed.
Emma, good morning to you. Look, as I said at the start of the show, we've just had a mini refresher course in the jolt from geopolitical headlines. I know that you're a buyer of gold. You see reaction function in bonds. You see it in yen. Is this where you see gold acting as some form of a geopolitical hedge?
Yeah, gold is a really interesting one. It's been, ignoring actually the last few weeks where you see some softness, which we think actually is a reaction of hot money. So on the result from Trump of that clean sweep, and you saw that US equity bounce, we think the gold came down in part because people were using it for liquidity. So they were just deploying it into that Trump bump, that US equity rally. But we think actually the levels akin to what Goldman Sachs have predicted for gold over next year, reaching around 3,000, are right. So not a huge rally from here, but holding, retaining its value. So we think in a well-diversified portfolio, actually, gold is less of an alpha generator and it's more of, it's capital preservation. It's actually there to provide some diversification where you see volatility in bonds, in equities, to really act as a ballast there for your portfolio.
That I'm really interested in, Emma, because I've seen a lot of commentary over the past, honestly, year saying that bonds are not the haven that they once were, that we shouldn't get used to going back to a world where we have negative bond equity correlation. I wonder if today disproves that. I know we only got some of these geopolitical headlines a mere 45 minutes ago, but can bonds be that thing in portfolio that in moments of risk off, bonds can gain?
Yeah, it's an interesting point. We spent quite a lot of time talking about the 60-40 portfolio and is it dead? I mean, ultimately, there's a lot of studies to show that it doesn't work in the way that it used to, but partly for a number of reasons. You know, high-frequency trading, the amount of liquidity in the market, alternatives really you need in the mix in order to provide that diversification. What I would say about bonds is we are bullish on fixed income going into 2025 because ultimately, other than the correlation with equities, why do you buy bonds? You buy bonds for income, and bonds are paying you income right now, well above inflation rates. You know, inflation has come right down on both sides of the pond, and so you are getting a real rate of return, a real rate of income from fixed income without really having to take on too much risk. We're not talking about high yield here. We're not talking about sex and violence. We're talking about T-bonds. We're talking about gilts. So from your, what would you consider your safest fixed income assets, you're able to get a real rate of return. You're being rewarded in the near term with income. And actually, although yields may not come down in a linear way that we were expecting, say, this time last year, do you remember what the outlook was for rate cuts this time last year? You will still be rewarded in the interim. So volatility, yes, but total return on the 3-5 year basis, absolutely, and income for now.
Brilliant. Sex and violence of the high-yield market. I wonder how you'd refer to the investment-grade market and to treasuries. We've yet to find our real sort of fair value in treasuries. Our next guest coming up after you saying that, you know, Donald Trump is a human steepener. Do you think every time we've seen this 4.5%, it's where real money comes in? Is that what caps us for now?
Yeah, I do, especially with inflation coming down. You know, there was a point where inflation and yields were on par, and so you didn't see that effect. But definitely 4.5 seems to be that magic number where you see that flow. I do agree that Trump policies does change the trajectory for yields, and actually not just in T-bonds. You know, we do have a global impact of the tariffs, and we're expecting here in the UK, as I'm talking to you, gilt yields to be higher actually going into 2025 than we were a year ago, in part because of Trump's policies. So I do think that yields will be higher for longer, especially since than we were expecting even 6 months ago. But long term, that trajectory is down. So as I say, income for now and total return over that 3-5 year period.
OK, bank those coupons. Emma, thank you very much. Emma Wall of Hargreaves, Lansdown. Other stories trending on your Bloomberg terminal this morning. This is what we got for you. Blackstone is close to an agreement to acquire the sandwich chain Jersey Mike's for around $8 billion. That includes debt, according to a person familiar with the matter. A sale could be announced as soon as this week, but a final deal hasn't been reached, and the talks could end without one.
Nestle trimmed its medium-term profitability target and will increase spending to promote its brands. Its new CEO is looking to revive its sluggish growth and restore investor confidence. It had relied on higher prices to drive sales during the inflationary period coming out of the pandemic.
Swiss watch exports fell for a second straight month as a sharp drop in shipments to China offset the growth in the US. The China and Hong Kong downturn is being countered by solid growth in exports to the US and Japan, with US shipments rising 11% and Japan rising 20%.
Coming up, Manus, we are going to talk about Trump's picks and what that might mean for this market.
We'll also have a conversation with Marko Papic, Chief Strategist over at BCA Research, on the state of the Trump trades. This is Bloomberg. It's Bloomberg Brief. I'm Manus Craney alongside Danny Burgett here in New York. Let's just check out what's going on with the bond markets. We've had a refresher course in the jolt of headlines. These are yields dropping more aggressively in Europe, Danny, than they are in the United States at the moment. We've got RBC Ukraine reporting the first strikes on Russian territory by Ukraine. And then you have this new top line that Putin has expanded the nuclear doctrine in terms of how and when they might use nuclear weapons in response to any aggression. So ground zero for the very first response mechanism is in the bond and the FX market.
Yeah, and equities, I should say, in Europe selling off much harder than that of the US, down 2 1/3 in the FTSE MIB in Italy. Let's get straight to Mark Champion of Bloomberg Opinion on this. Mark, so Manus mentioned all the various headlines that we were watching out for this morning. Can you just run us through the significance of them and whether any of it is escalatory?
Right. Essentially, what the Russians have done is to say that a nuclear update that they said was coming some time ago. They released the details of what it was going to say, and now they say, well, today Putin signed it. So I think essentially what they're trying to do, they had intended that update to put pressure. As all of the nuclear threats. So they're designed to put pressure on the Americans and the Europeans to limit what they give to the Ukrainians. It's been a very successful policy. And then the question, you have to ask is, what has changed this time? Does this, new doctrine, will it sort of materially change anything? There's a couple of things to say. First of all, that it's not the actual doctrine that decides what Putin does in an emergency, what the army does, that sort of process. That is all classified and may not have changed at all. Second thing to say, sorry.
Sorry, no, go ahead. Please finish, Mark.
No, and then the second thing to say is that, so really, these doctrines are the public doctrine. They're for diplomatic use, for public use to kind of set the frame. The previous doctrine didn't limit what Putin could do. He is all-powerful in that sense. He has the ability to do what he thinks is necessary. And this one won't either. So in some ways, nothing has changed. The only question is, he's sending a signal, and the question to the analysts in the White House, in U.S. security, European security, defense establishment, is to decide: does this signal mean that he really is serious now, that something has changed, and he's willing to push the nuclear button? My own view on that is simply everything is possible, but would not make any sense. He is now winning in the war. At certain points during the war, he wasn't winning, and he didn't use the nuclear option then. He's now winning. And secondly, he has a new U.S. administration coming in that has said it wants to end the war and is willing to put much more pressure on the Ukrainians than the current one. So it would be a strange time to make this move, and it is very difficult and costly for him to use nuclear weapons.
Well, it could well be that he's using this window in between Biden exiting and Trump arriving as his opportunity to escalate verbally. He does say that non-nuclear states that are supported by other nuclear powers can be a target. So this verbal deterrence, Mark, in many ways, it's to try and counteract the last push forward by Zelensky to try and get some upper hand before these negotiations start.
I think that's absolutely right. And that's how we should see it, how we should frame it. The question then is, what do we think this really means? As you've reported, the first attack has been used. The language even in this updated doctrine says what's required is a mass attack. Conventional attack would be sufficient on Russian territory. One ATACMS missile is not a mass attack.
Okay, Mark, just as you're finishing your conversation, we're showing live pictures of President Zelensky. He's going to be addressing the European Parliament. Let's just take a moment there. Okay. We'll keep you abreast of any headlines that come through from the Ukrainian President Zelensky addressing a special plenary session, I should say, of the European Parliament, marking 1,000 days of Russia's invasion. Right here in the US, Bloomberg is learning that the President-elect Donald Trump is considering appointing Kevin Warsh, the former Federal Reserve official, as Treasury Secretary. That would be alongside the hedge fund manager Scott Bessent as the director of the White House's National Economic Committee. Our senior editor, Michael Shepard, joins us from Washington. So, Shep, the markets were all G'd up for a Bessent Treasury Secretary. We understand that Bessent won't accept the proposition to him until he knows who the Treasury Secretary is. So again, this is like a cliffhanger, isn't it?
It's really turned into a cliffhanger, and it is taking a bit longer than we had expected. I think a week ago, we were speaking about this on air, about how we might see it even before last weekend. But the process is dragging out. Trump is to meet with Warsh later this week. But the two things that these men bring to this role, to these roles, possibly are a familiarity with Donald Trump and Wall Street pedigree, which is really crucial for the president-elect. Warsh was considered by Trump during his first term as a possible head of the Federal Reserve. And Scott Bessent, of course, has backed the president financially and also in kind through his comeback campaign. And he's been advising the president even through this process. So we'll see how this plays out this week. Each of these men would be able to speak to Wall Street and bridge the gap between the financial industry and Washington.
Shep, I guess one of the confusing things about Warsh specifically is part of the reason this fight broke out into the public is you had someone like Elon Musk saying that Scott Bessent was someone who was just status quo. Couldn't a lot of Trump allies make the same argument about Kevin Warsh? I mean, this is a man in 2010 who argued very publicly for open and free trade in markets and against protectionism.
You know, Danny, that's a great point. And that I think highlights the underlying tension in the Trump camp right now. They would like to go far, but then how far do they take it? Because the markets will start to see some of these policies, including his promises to impose wide-scale tariffs on the European Union and even heavier duties on goods coming from China, his immigration plans, and his tax cuts. All of these present different forms of risk. Even as they're enthusiastic about tax cuts and everything else, there are latent risks in all of this, and they need someone who can communicate effectively. And if you bring it to the markets, and if you have somebody who is too iconoclastic or unfamiliar with the major Wall Street trading houses and global financial counterparts, it could be problematic. And Warsh solves that problem in a way, even if in his past he has expressed some misgivings about the kinds of tariffs that Donald Trump is intending to impose.
Okay, Michael, thank you very much. Great reporting, Mike Shepard there in Washington. Well, stock in Google this morning are falling pre-market after the Bloomberg scoop. The DOJ is looking to force the company to sell the Chrome browser after a judge ruled that it was monopolizing the search market. What would the impact? Tamlin Basin is of Bloomberg Intelligence. So here we are, again, another cliffhanger. This was started in the first Trump presidency. Here we are. The possibility is that the Chrome browser may have to be split off. That could be seriously injurious to their AI future, couldn't it, if that's the road that we go?
Yeah, absolutely. So the Chrome browser is really essential for Google. It's what they get a lot of data on users browsing Chrome browser. They use that data to feed in their advertising practice. Obviously, it helps support their search monopoly, and this is where the sort of the underlying case was on Google search monopoly. And earlier this year, the federal judge did find against Google in a liability trial on search, saying that they used illegal practices to support that monopoly. And so what we're looking at now is heading into April, there's going to be a trial on remedies. And this, what we have today, is the DOJ putting forth what they think those remedies should be. And of course, the most onerous of those would be splitting up and forcing Google to sell Chrome. We don't know how the judge is going to decide, but this is sort of the DOJ putting forward what they think the remedy should be.
Well, in April, it'll be a completely different DOJ run by, well, who knows at this point. Tamlin, I mean, what does that mean in terms of some of the last gasp of the Biden administration trying to make some of these efforts come to fruition? Can they stick in a second Trump term?
Yeah, absolutely. And I think to Manas's point that this was a case specifically that was brought under Trump's first administration. So in terms of this case, I think the judge isn't going to pay too much attention to who's in the White House. The judge is going to look at sort of the remedies proffered by the DOJ and by Google. But it is the big, larger question out there is how is tech enforcement going to look under a second Trump administration. Now, we do think there might be a relaxing on things like M&A perhaps, but a lot of it really is going to depend on who Trump puts in place in these key positions, both at the DOJ and at the FTC. So we're really going to have to see the personnel that he puts forward. But generally, regulating against big tech has been fairly bipartisan over the last 5 to 10 years or so. So it might not be a huge change going forward.
Well, there's been a lot of discussion about Lina Khan in terms of her future. Tamlin, thank you very much. Tamlin Basin there of Bloomberg Intelligence. Quick snapshot of markets. We have a small jolt this morning. One could say S&P futures down 0.4%. The narrative is, of course, that the first strike from Ukraine into Russian territory, and then we have this approval by President Putin in terms of expanding the nuclear weapons doctrine. How much of that is new news in terms of the expansion of the doctrine, Danny, and how much of it is a refresher course in jolted by the headlines. And we're going to have more of this. US stocks are lower by 31%.
It's your Bloomberg Brief. Danny Berger alongside Manish Cranny in New York. We're monitoring markets going squarely into risk-off with fears of growing tension. You're looking now at Ukrainian President Zelensky addressing a special plenary session of European Parliament, marking 1,000 days of Russian invasion. Manis, he's saying that he's concerned that North Korean troops in Russia might grow to 100,000. This is various headlines hitting the tape on fears of a nuclear doctrine getting signed by Putin in Russia.
Yeah, and the escalation has been pretty fast, hasn't it, Danny, between the amount of troops arriving to help Putin in the war effort and then the U.S. shifting on its position on these longer-range weapons, which have now been activated. And as Zelensky himself said, it's action, not words, that matter.
Yeah, and here's the reaction in markets. I mean, it's Russell 2000 futures selling off the most, which doesn't make sense because these are domestic companies. So maybe it just underscores the fact that it is just risk-off everywhere you look. Looking forward then to catching up with Marko Papic of BCA Research. He's going to give us his take on the latest. From our global headquarters in New York, welcome to Bloomberg Brief. Danny Berger alongside Manish Cranny. Let's set your agenda.
Stocks turn lower, bonds rally. Local reports state Ukraine has carried out its first strike in Russia using American-made missiles. President Putin approves expanded use of nuclear weapons. Narrowing the search, President-elect Donald Trump is said to be considering Kevin Warsh for Treasury Secretary and Scott Bessent for the NEC. The last push from Biden's DOJ. The plan? Split Google and its Chrome browser. More on the Bloomberg Scoop coming up. Danny, good morning.
Manis, a quick whip through markets because they were shook this morning. Headlines first coming out of Putin signing an expanded nuclear doctrine, which was expected. And then the headlines that, according to local sources in Ukraine, that Ukraine has looking at launching the first inside Russian territory long-range missiles coming from the U.S. You can see the reaction is most acute in Russell 2000 futures, where I said this before, these are domestic stocks. They probably shouldn't be impacted, but just shows the impulse and the nerves in these markets. Europe stock 600 on the bottom of your screen selling off more. Same goes to the bond market. European bonds rallying more, but bonds rallying across the board. Maybe they are the haven that we wanted. The euro also turning lower. The dollar had snapped its 7-day winning streak, but man is stronger this morning again on geopolitics and haven.
I think we've just had a refresher course in knee-jerk reaction to headline news. The first strikes by Ukraine into Russian territory. What does that really mean? Is the updated doctrine really a renewal of pressure? Is it verbal pressure that Putin is so good at capitalizing on the vacuum here in the United States of America between exiting Biden and entering Trump?
I just think the market reaction is so telling, Manis. The fact that you can have oil barely react to these headlines and that you can have something like small cap selling off more, I think it just shows how edgy this market is and that it doesn't take a lot to really throw it off when we have run up so much. So we'll see how much of this sticks. We'll see how much of this is an escalation or not. But for the meantime, it is having a real impact.
And it's much more of a negative impact on European assets, on the euro, on the stock 600 than it is to some of the US assets, despite the Russell. She'll be on Twitter later on telling you about the value in the Russell. Our guest this morning is Marko Papic, Chief Strategist at BCA Research. Marko, good morning. Just listening to the headlines, the first salvo from Ukraine into Russia, Putin expanding the use of the nuclear weapons doctrine. I put it that this is a refresher course for all of us in the jolts that we're going to have to get used to. The first reaction to this sequence this morning?
Well, I think that what's happening here is the Biden administration is trying to lock in the incoming Trump administration in a certain course. And that's why they allowed this use of long-range missiles ahead of the inauguration. It reminds me of when George H.W. Bush actually committed troops to Somalia in 1992 at the end of his term, so that the incoming populist president, isolationist at the time, people thought President Clinton would be locked into the New World Order. Mm-hmm. And so I think that's a very similar idea here. I don't think that Putin has a reason to overreact. That would be self-defeating. Obviously, he has an incoming administration that has stated it wants to negotiate. Everyone's trying to ratchet tensions ahead of those negotiations. That does tend to happen whenever we have a military conflict. In the last sort of gasp of a conflict, you try to acquire as much territory, you try to ratchet tensions, so you have a better negotiating position. I think that's what's going on.
So to be clear, this is all just a precursor to maybe the war ending, to some sort of negotiation being formed. Is that what you're saying?
You actually see this in a lot of military conflicts, that in the very end, that's when both sides try to ratchet up a territorial acquisition. I mean, I see Ukrainian acquisition in Russia of the Kursk Oblast when they invaded Russia in the same light. It's a way to bargain. You increase your chip stack so you can actually trade it away. And so, yes, I think that obviously Putin is going to try to also flag aggression and assertiveness and willingness to continue the conflict so that the price for negotiations for the West becomes higher.
What is the most important way to approach trading these markets over the next 4 years? You sat down in the seat and we were chatting casually about how much volatility there will be to come. But this is about positioning in a framework, isn't it?
Yes, absolutely. And also knowing where the macro fundamentals are. So I think one of the things about geopolitics is often investors overstate the tactical importance of geopolitics. I actually think geopolitics and politics is far more important for your strategic asset allocation than it is for tactical. Oftentimes, the way to actually trade politics and geopolitics is to fade the risks. You mentioned oil didn't react to the latest Russia-Ukraine tensions. You know why? Because we learned in 2022 the risk of going long oil because an oil producer is engaged in war. I mean, how did that work out? Oil prices crashed in 2022 because the market fundamentals were not bullish commodities at the time.
So that's the geopolitics of it all, but there's also the volatility of just Trump. And I think even before he's been inaugurated, we're being inundated with headlines and trying to figure out what does it mean? What does his Treasury Secretary picks mean? What is your recommendation to clients as they sort through all of that, as they try to decide what is market importance, what is market moving, and what is not?
So I think that over the past 6-8 months, I think we've murdered too many Excel cells in trying to, compute all the different policies of the Trump administration. And I think that's very difficult because there's so many. There's trade, there's tariffs, there's migration, there's growth, there's tax cuts. I want to just be very simple, stupid almost. I want to focus on what we know most. And what we know clearest is that his tax cut policies are, stimulative to the economy. And so that's why I've called Trump a human steepener. Yeah. In a way, that's happened already. And now the bond market is kind of digesting that for a period of time. I do think the Treasury Secretary pick really matters. I think it buys the administration time before they have to propose legislation. So I think the team that's being, sort of quoted now, you got Warsh in Treasury, you've got Bessent in NEC, very good. That means Bessent is going to be very close, by the way. NEC is important. You're in the White House. You're close to the president. You're going to have actually maybe even more influence.
I mean, Bessent, we understand, won't accept the job until he knows who the Treasury Secretary is, and that kind of makes sense when you've been in the running. In terms of the program for debt, and that is what matters most to this Treasury market. So that pairing, what does that say to you about the risk on the fiscal front next year and the debt front?
So I would say that the risk is pushed off into the legislative phase. And what I mean by that is that had he picked a Treasury Secretary that Wall Street didn't have confidence in, I could see a bond market riot like tomorrow. Well, literally today. Bond yields go up. But if you have a competent team that knows how to conduct open mouth operations, all important OMOs, then those yields can settle. And then we have to wait for the legislation, the legislative process, the reconciliation bill that will start being put together in April and May. The problem is I don't see how President Trump tempers his most profligate promises without more pressure from the yields. So I would say that on a 0 to 6 month horizon, I can see yields going higher. Then I see this team that he has assembled telling President Trump, look, we need to temper the impact on the deficit. And then I see yields going lower than maybe expected on a 6 to 24 month horizon.
So you think Trump and his team can be regulated by this bond market? Because there's been a lot of thoughts that it's the equity market that he cares about, and the sequencing matters a lot as to whether he does tax cuts first or tariffs. So how do you see the bond market being the thing that regulates them? Again, even when we've seen auctions come on and there are fears of, we're going to have a failed auction, it's going to look something like the UK, and it just never materializes.
Well, let's wait a little bit. Let's give the bond market a little bit of time. What I would say, everyone can be tempered by the bond market. What did James Carville say, right? I want to be reincarnated as a bond market. Everyone's afraid of you. And I think in 1994, we had the bond market riot last time in the U.S. history, 20 years ago. It wasn't the foreigners that sold the treasuries. It was domestic private holders. U.S. was a reserve currency. I think that can be repeated. To your question, equities versus bond, what will discipline President Trump? Well, I think both. If we get into 475 territory on the 10-year yield, it's probably going to have an impact on equities, negative. And especially the favorite trade that everyone has on right now is what? Small caps, right? That's not going to work if those yields keep going higher. Regional banks, that's not going to work if yields go higher. Regional banks, I mean, that's.
Do you think 475 is enough to temper perhaps the most profligate policies? I mean, who blinks first? The Trump put or the Fed put? I mean, the Fed put is open-ended, but Trump blinks first.
I think that Trump will blink first, and I think that in previous iterations of this kind of a situation, the central bank has always been supportive of their sovereign debt market, obviously. They don't play politics. They come in and support, but they do extract concessions. What did Mario Draghi want for purchases of peripheral debt in 2011, 2012? He wanted concessions on structural reforms and fiscal policy from Italy and Spain. What did the BOE want from Liz Truss?
Yes.
Right? So I think that the big surprise, from the next 6 to 12 months, as we digest all these policies, the big surprise will be actually far lower fiscal thrust, far lower contribution of fiscal policy and G on growth, because Trump will eventually be disciplined by the bond market.
I also wonder, to that point, if something that's going to hold back not just the U.S., but global governments, this idea we've had regime shifts everywhere, and it's largely due to inflation. Do you think governments are going to learn the lesson from that, that if we are in a crisis, if something like COVID happens again, that they're not going to want to spend their way out of it for fear of this very moment that we're in?
So, Danny, I've kind of really made a point over the last 4 or 5 years arguing that we have moved away from Washington consensus to something new. And I've called that something new the Buenos Aires consensus. I was looking for a fancy term, so I just picked on Argentina. Well, it's interesting because the one country that's moved actually the furthest away from this kind of profligate, dirigist, statist way of conducting economic policy is actually Argentina. And you're starting to see anomalies across the developed and emerging market world. Canada is about to elect a libertarian-leaning prime minister. Germany is about to have a chancellor who wrote a book titled More Capitalism. And yes, in the U.S., you have a team. I mean, Scott Bessent was on Nikki Haley's team. I mean, and Nikki Haley ran on effectively a laissez-faire austerity, Margaret Thatcher supply-side reform policy. So I do think something is happening. I think we've peaked with profligacy, and I think we're slowly moving towards actually more laissez-faire capitalism without anyone expressly voting for it, but policymakers can sense and that they have to move that way. Why? Bond market is a disciplining mechanism. It's a material constraint. And I always emphasize material constraints over policymaker preferences.
Right. No one wants to be the leader that upsets the bond market. Marko, so wonderful to have you on. Please come join us whenever you want to move away from sunny California and into dark and cold early mornings in New York. Marko Papic of BCA Research. Okay, coming up, we are going to dive into big tech and some of the ramifications there of Biden's DOJ's last gasp. This is Bloomberg. President-elect Donald Trump is said to be considering appointing Kevin Warsh, a former Fed official, as Treasury Secretary, alongside hedge fund manager Scott Bessent as the director of the White House's National Economic Council. Let's get over to Bloomberg government reporter Kate Ackley, who joins us from Washington for more. Kate, what do we understand at this point?
Well, good morning. Nice to be with you. This is a team that I think Wall Street would celebrate or at least be comfortable with. We expected to hear a Treasury Secretary pick. Last week, there's been some behind the scenes sort of back and forth infighting among, who's going to be in that role, which is subject to Senate confirmation, the Treasury Secretary. But as things have moved forward this week, it seems like they're putting together a team that would broadly, be embraced by Wall Street.
Look, one of the big issues is we understand Wash won't sign on to NEC until he knows who the Treasury Secretary is. Sorry, Bessent won't sign on until he knows who the Treasury Secretary is. And part of the discussion around Kevin Wash is it's about that loyalty to disruption, that loyalty to tariffs. And I think Danny's mentioned it, various people have mentioned it. There's the 2011 op-ed authorized with Jeb Bush, which is about a slightly different opinion, perhaps, to what Trump wants.
Right, that's that sort of establishment Republican versus the populism that we see with the Trump-Vance team. So there's a balance going on there.
Okay, so we're going to try to get that balance, which, by the way, Vance has been absent from all of Trump's photo ops and his UFC days. We're also going to have today being the deadline for Trump's hush money case to either proceed to sentencing or delayed. I mean, this is something to keep in mind, that these things are still happening in the background. Kate, how does it color this moment?
Well, I mean, Trump was reelected knowing that he had this conviction. So it wasn't a surprise there. And this is a pivotal day. This could be pushed off for 4 years. It could be completely scrapped. Or there could be this sentencing hanging in the balance as the Trump team puts together the incoming administration. So a lot going on today.
There is indeed. Kate, thank you very much. Bloomberg government reporter Kate Ackley on the trail in Washington. President Biden's Justice Department making the final push to crack down on big tech. The DOJ is looking to force Google to sell the Chrome browser. Now, this comes after the judge ruled in August that it's monopolizing the search market. Tamlin Basson is with Bloomberg Intelligence. Tamlin, good morning. This is perhaps the worst remedy of all. This is the very core of the future for them in regards to their AI product and the development. Is this the worst case scenario?
Yeah, I mean, this is a pretty frightening recommendation by the DOJ for Google, just because how much it relies on that Chrome browser. This is something they rely on to really get a lot of data that they then use in their advertising practices. However, I should point out that this is just merely the recommendation of Biden's Department of Justice. This is a recommendation that's going to go into a trial that the judge is going to hold on remedies. That trial is going to be held in April. So really right now, we're just seeing what the DOJ is suggesting the judge do. It's by no means clear that the judge is going to follow those recommendations.
There's been so much back and forth about what a Trump term would mean for big tech. In Vance, you have someone who likes little tech. You have Trump, who's both criticized and embraced big tech in the past. These kinds of actions, which you and Manis have rightly point out that this specific case was brought under a Trump presidency. Is it likely to change once Trump comes into office? Is he more likely to be friendly or more scrutinous to big tech?
Yeah, I mean, to some extent, that's an open-ended question because we don't yet know the kind of personnel he's going to put in these key positions, both at DOJ, at the FTC. So a lot of this is going to be personality-driven based on who he's going to nominate for those positions. But I think you're absolutely right. Trump hasn't been all that favorable to the big tech community, and we don't necessarily think that's going to entirely change going forward under the new administration. But the details of that are going to depend on who he's going to select for these positions.
Talk to me a little bit about Huawei, because obviously they've had restriction on their access to some of the leading technology. What does this tell you about the regulatory environment for tech companies and where they find themselves now? Because as we go forward, again, we've got a president and a vice president talking about the whole tech sector as well and about the censorship. That's one aspect from J.D. Vance. But what about the regulation going forward?
Yeah, and I think if you look at Huawei and this sort of supply chain bottleneck that they're experiencing really is the intended result of these restrictions that the U.S. led in placing on Huawei. And I think the read-through between both Google and Huawei is that this is just sort of the regulatory environment that the big tech sector is going to face going forward. And I think it's not just the U.S., it's also Europe. That this is sort of just the new status quo that I think the sector is going to have to start dealing with in the years to come. But we don't really see that relenting anytime soon.
Okay, Tamlin, thank you very much. Tamlin Basson there from Bloomberg Intelligence. Another stock that we're tracking today, it's Walmart. We're going to get the numbers pre-market, and it's just ahead of the third quarter earnings. Eric Fanner is with us. So Walmart, are we going to spend on this holiday season? What's the outlook in terms of the delivery? They've been working really, really hard with their club program to overcome perhaps some of the less of the appetite from the lower end of the market, haven't they?
Yeah, that's right. I mean, Walmart's been doing really well of late. They had a super strong second quarter, upgraded their guidance at that point. The shares have been doing really well since then. So I think, there's anticipation that that momentum is going to continue. I mean, as you say, the big question at this point now is the holiday season. How will they do during that period? It's a little bit of an unusual holiday season. It's a couple of days shorter than last year. Than typical, so there's some uncertainty. Obviously, you've got the whole election effect, new administration coming in, talk of tariffs, interest rates are still, kind of sticky, which has, kind of curtailed some of the spending on home improvement, things like that. But the food business for Walmart has been doing really well and taking up the slack. So, that's widely expected, I think, to continue. So we'll have to see, how well do they, lift other boats. But Walmart itself is, has been cruising along.
Yeah, we'll get those earnings in about 1 hour and 10 minutes, Eric. We'll also get Lowe's earnings, too. Home Depot had a pretty strong showing thanks to the fact that there were hurricane effects and people had to rebuild and get outside and fix what had been broken. But it is a very strong consumer at this moment, but a weak housing market. How is that turning out for some of these home improvement companies?
Yeah, that's right. I mean, as you said, Home Depot, some days ago, they upgraded, but it was from a very weak base. I mean, as you said, the question there was the housing market to some extent. That's been hanging over them and Lowe's, with people kind of unwilling to spend on big ticket stuff for their houses, fewer houses being sold and bought, and so that kind of weighs on that spending. Now, that the interest rates have been coming down a bit, so there's some sense that might be ending. As you said, the hurricanes and the other weather effects were kind of a mild positive for Home Depot. There's some expectation that Lowe's could get, a similar or even potentially greater benefit from that than Home Depot. So that kind of mitigates some of the weakness that we've seen, overall in the housing market. But, it's clearly there's still kind of a bit of a mixed bag there, not necessarily the same kind of, holiday shopping boost that you might see at Walmart, for instance.
I believe it is 5 days less we will get this holiday season to get our shopping in. So good luck to everybody. Eric, thank you so much. Bloomberg's Eric Fanner. A quick check on markets this morning. As we've been tracking a textbook risk-off day, stocks lower. Russell 2000 leads the pack lower, as does Europe. Same goes for bonds. Bond yields are moving lower, Manus, and the most of which is coming from Europe. Let's get you set up for your trading day on this Tuesday. Walmart and Lowe's, they will be reporting earnings before the bell. We'll get some economic data. U.S. housing starts. That's at 8:30 a.m. Eastern. And then we'll get the ruling on President-elect Trump's hush money case in New York. That will take place later today. Manus.
Danny, some of the micro movers on defense, Lockheed Martin and General Dynamics, both defense stocks gaining on the local media in Ukraine, saying armed forces have carried out their first strike on Russian territory. Supermicro surging on reporting that it hired a new auditor and filed a plan to come into compliance with NASDAQ listing requirements.